Welcome back to the Beat the Odds of Business and Wealth podcast. We have a special Thursday evening edition for you coming your way. So,
all right. Thank you for accommodating me, everybody. Just
Trevor's going in for surgery tomorrow. So
Yeah.
he's going in for surgery tomorrow. I asked him about doing it during the surgery and staying awake during the surgery, getting a local instead of a general. But apparently he's not hardcore enough to do that. So we're going to do it Thursday evening instead.
Blame it on me. I'm not H-core enough. All right.
Didn't want to do a local anesthetic and do the live at the same time. Okay. So we're going to talk because all the talks about the Ontario housing market.
Yeah.
People are wondering what the heck is going on, and I'm not sure they're around the target, a lot of people, but I don't think they're quite right on the target. And so I want to give some clarity on what's happening in the housing market, because it's a vast difference from coast to coast. It's a vast difference from coast to coast, and sometimes the noise out of Ontario kind of clouds things. But the parallels between the different markets will give you some insight on what's happened and what to expect moving forward. And so Trevor, I'm going to try to convince you what the four most important variables are in Canadian home prices.
Okay.
And neither are rates or purpose-built builds.
Neither are rates
or purpose-built builds with the honorable mentions. They would not be in the top four. So interest rates and purpose-built rentals would not be in the top four.
Okay. All right. Well,
I'm
I'd like
try
to
to
see
convince
what you
you
got.
of this, okay?
Because, the rhetoric out there is all because of these condos in Ontario, right?
Yes.
So let's debunk that. Let's talk a little bit about that and get into it.
So let's look at the chart here. Let's look at the chart. And this is, on our Instagram channel right now. The Ontario housing market is bleeding red, Armageddon, down by 5.2%.
Wow.
Down by 5.2%. Meanwhile, Alberta up by 4.2%. Saskatchewan up by 5.6%. Manitoba up by 7.6%. It's not all red out there, people. It's not all red, and when you compare the differences between the two, you start to understand what's really going on and what's really important, because some variables are more important than others, and we're going to talk about which ones are more important. So it's not that rates are unimportant. It's not that purpose-built rentals are unimportant. There's just other things that are more important. So I'm going to give you some numbers.
Okay, sure.
I'm going to give you some numbers. Okay. So we'll start with let's start with the jobs. Okay.
Oh man.
Let's start with the jobs, because the jobs are important, and I'm going to compare Alberta and Ontario. Okay. And I'm going to compare them because the job numbers are terrible in both. So the job numbers are terrible in both, where, we have a national unemployment rate of 6.9%, and we have an unemployment rate in Alberta of 7.8%, and an unemployment rate in Ontario of 7.6%. Interesting. So the unemployment rate in Alberta is actually higher than Ontario, because guess what? Surprise, surprise. Trump tariffs are bad for Ontario jobs. $59 a barrel oil is also bad for Alberta jobs.
For sure.
Not so good, right?
Both things bad.
Those can affect both of them, right? And this is where I'll say, why would I think, jobs are in the top four. And that'll be the first one on the list. So I'm going to go from least important to most important here. And the jobs will be on the list because, if rates were half what they are now, but unemployment was 25%, no one's getting a mortgage.
No, because you got no job.
So you just have to, so are rates important? Yes, but is jobs important? More so. It's a bigger lever, right? But if you look here, it's you have two employment markets that are weak in both Alberta and Ontario, but the housing market's weaker in Ontario. Okay, so that's number one. Okay, the next one, let's talk about the supply. Okay, let's talk about the supply where new home starts. If we look from 2022 to 2024. Now, this wouldn't be an exact science because it's not like everything started a year ago is done, okay? But it's also not like anything started this year is not done. You know, some houses could have finished and started and finished the same year. But if you look at housing starts in Alberta from 2022, so the beginning of 2022 to the end of 2024, you're roughly 111,000 houses started. Okay?
Is it single-family homes?
That's just housing units altogether.
Okay, so it includes apartments, condos, single-family townhouses.
Yeah, excludes purpose-built rentals.
Yeah, of course.
Excludes. Okay. Now, the next one would be Ontario, 273,000 units. Okay. 273,000 units. Okay. So when we talk about the supply, like now it's, supply is definitely important. Like, are there actually any houses out there? Once you have a job, okay, are there any houses out there to buy? Okay. But in order to really understand the difference between supply, you really kind of have to understand the demand of the number of people who are there to buy a house. Okay. So I'm going from the beginning of 2022 until the end of 24 on housing starts to roughly estimate the houses that came online that are online and available now. Okay. And in terms of population, I'm going to give you the population growth from the end of 2022 until now.
Sure. Yeah.
Because you could have arrived yesterday. You need a house. You can't wait a year. Okay.
Yeah. Well,
you need somewhere to live.
Yeah. Well, I mean, we've known for years there's been a massive deficit in the number of homes that we need versus how many people need homes. So let us know, like, with all the new people coming into Canada, what does that ratio look like?
Yeah. So Alberta went from 4,560,000 at the end of 2022 to we have roughly now 5,029,000. So in Alberta, we added 469,000 people.
In what time frame?
This is from the end of 22 until now. So we're almost at 3 years.
Wow.
Okay. That's in one province. Okay. Ontario, on the other hand, at the end of 22 went from 15,305,000 to 16,258,000. So an increase of 952,000. Okay. So we have Alberta going up by 469,000 and we have Ontario going up by 952,000 people. Okay. And so this is where I tell people, it's like, demand's more important because you double your population tomorrow. It's like, it wouldn't matter what the supply, like the prices would go through the roof. The prices would go through the roof, right?
Oh, of course.
Even if unemployment was 10%, if you had if you start adding 1 million people a year in a province, like all of a sudden, the prices would explode even in tough employment markets, right?
Yeah. Well, I mean, the very basics of economics, supply and demand, more and more people after less and less, fewer and fewer goods, the price goes up.
Yeah.
There's no way around it.
Jobs, supply, demand. And maybe somewhat the supply is like the existing stock will always be there realistically, right? And realistically, you can only build so many houses in a year. But as we've seen, it's way easier to let people into the country than it is to build houses. That is part of it. And so, going back to the beginning, it would be the honorable mention would be the rates and the number of purpose-built units. And so, like, I know the argument people say that purpose-built units affect it too. Trust me, they do affect it. But for whatever reason, we have this, like, psychology of some people just want to own a house.
Yeah.
However irrational the cost of home ownership might be in their situation, they're just going to choose ownership. Right?
Well, it's the American/Canadian dream. Own your own home. Have the white picket fence. Have wife and couple of kids and a dog, and all is grand, right? So people have this idea in their mind that is the ideal, and they're not wrong. Like, they should want to own property, and they should be able to own property, right? And it shouldn't cost them, like, where are we at now? Like 16 times median income to buy a home in Canada.
That's right.
That's insane.
That's right. And so they're going to blame the disparity here on the property prices on Donald Trump on the CBC. Okay, tariffs have been hard on Ontario. Yeah, they have been. But $59 a barrel of oil has been hard on Alberta jobs too. Okay. And the net migration into the province too has also been hard on unemployment rates. Okay. So you end up with unemployment in both provinces that look very, very similar, 7.8 to 7.6. Okay. Materially almost the same. Okay. In fact, it's higher in Alberta. It's higher in Alberta than it is in Ontario. But crunch the numbers on, it's not the aggregate number of houses, it's the houses per, new person in that population subset. So that means in Ontario, for every 1,000 homes, new homes that were constructed, they let in 3,500 new residents. Okay.
Wow. So that's a terrible ratio. Like how is that sustainable in any world?
I mean, if
where
you have your 2.2 kids, you can have your 4.2 people chasing the 42. You know what I mean? Like that's like I guess, right? Yeah. But wait till you hear the Alberta number.
Okay, but also don't forget we already have a housing shortage. Have a housing shortage that existed.
Right. That's right. So the single person who wants to live in their own house, or a couple without kids, it's like, get a couple of roommates, right?
Yeah.
So, or the couple living out their golden years, right? It's like you're right. The ratio is like you need more houses than that, really. I mean, that's why the number is like it's down by 5%, but it's still $833,000. Like, yeah. That's why it's still that high, right?
Yeah.
It's not because Ontario is the next coming of Miami Beach or something like that, right? Like that's so it's not Manhattan, right?
Right. Yeah.
Alberta, like here's the numbers. Like for every 1,000 homes constructed in Alberta, we took in 4,200 new residents.
Wow.
So that's why. So again, in Ontario, for every 1,000 new homes, there's 3,500 new residents in the last 3 years. Whereas in Alberta, for every 1,000 new homes, there's 4,200 residents. What do you get? Both provinces have unemployment issues, significant unemployment issues, but the Alberta home prices aren't suppressed. Okay, they're actually going up.
They're going up.
They're going up, right?
Wow, that's great for anybody who has a home if you're ready to pull some equity out of it and invest it. But for anybody who is just entering the market, remember when we used to have such thing as a starter home. The starter home, right? You start in the smaller home, and then you live in that for a few years. You trade that in for a bigger one because you got more needs, bigger family. You get your one kid and maybe a goldfish, and then you sell that house and you get to a bigger one because you got another kid and maybe you got a dog this time. You got more expenses, and you just want to live in a larger home with a bigger property. That isn't happening anymore.
That's right. So that's what I'm saying. It's like all these things are important, but it's important to understand which ones have more significance than others, because every province has lower rates than what it did a year ago.
Yeah.
It's the same. The interest rates are the same. Alberta has vacant purpose-built rentals. We have increasing vacancies in rentals, but they still want to own a house. Right or wrong, humans are emotional creatures, and the desire for home ownership is there. Okay, so some people, they're not even considering rentals. They're not, right? They're only considering buying a house, whether that's mathematical or not, or whether they're making a rational decision. But that's the decision that they're making. Okay, and when you have 4,200 new people coming in, and there's only 1,000 new homes to choose from. There's therein lies the issue, right? Yeah. And so, we look at it as rates and new purpose-built rentals, honorable mention, but jobs would be number one. Okay, in order of increasing. Supply would be number two, because you're always we're just talking about new supply. It's not like the old homes will go anywhere. Okay, but demand can increase dramatically, and it can increase quickly, and so we have to understand it. And there's a relationship between the new supply and demand, but effectively the old supply is still going to be there, short of some cataclysmic event that knocks out, houses like you wouldn't believe, or, and the construction, like until we, they all force us to start living in the government-sponsored shipping containers or something like that. Like we're not going to construct that many new.
They're starting that in the
year,
Maritimes first. I think there's a news story on it.
Jobs, supply, demand.
What's the number 4?
Number 4 is the one where it's like there's fundamental details, right? But almost all of the real estate guys out there, it's like they look at real estate fundamentals and they forget the most important variable in all of these financial decisions. How many of these are out there? How many of these are out there? Because we're looking at declines in the entirety of Canada, right? Whether it's strong employment or when I say declines, off the highs, okay? Mm-hmm. So we're looking at the peak in 2021 was 777,000 was the average house in Canada. 777,000. And now we're down to 690. Okay. A meaningful decline, and people say it never declines. You can never leave money on real estate. Well, if you only had 5% down the deal and you bought your $770,000 house, you haven't just lost all of that 5%. You've lost all of it a couple times over, right? So,
remind me what happened during 2021.
Yeah. I mean,
massive money printing.
There you go. There it is, right? And I see all of these real estate analysis, and they're looking at rates, and they're looking at purpose-built rentals, and they're looking at jobs, and they're looking at supply, and they're looking at demand. The most important number in it is the increase in the money supply. Okay. Even if you have cheap rates, if you can't get a loan, there's no increase in the money supply.
Yeah.
Okay. And so you can have, 10% unemployment, and you can have like much harsher economic issues, and the price of houses could skyrocket. If you don't believe me, just look at what happened in Argentina. And so that's an extreme example. I'm not suggesting we're Argentinian rates of increase in money supply, but that's really what it means. Ultimately, the money supply would actually trump all of those variables. They would trump all of those variables, because even if someone didn't have a job, you have to remember that there's still money out there. Okay. Most people think that all the money comes from earned income. That's,
No.
If you look at the wealth distribution, that's not how it works, right? If the money supply increased dramatically, the richest people would just be buying second and third houses for fun. Because their other assets would have gone up that much that it wouldn't even be a meaningful decision for them, right? And so we have to look at what was the M2 money supply for the last 54 years, and it was 8.1%. Our population's only grown by about, call it 1.2%.
Right.
It grew a little higher post-COVID. It grew lower during COVID, okay? But it's actually not as big of a difference as people think. But it's 8.1% is the growth of the money supply. What happened in 2020 is we increased the money supply by 18%.
Oh man! Wow.
When was the last time we did that? It's like, well, we did it in the 80s, and that's what led to the crazy high inflation then, right? It's a tipping point where that money starts to spill out everywhere, right? And so, as loose as that was, and the big dramatic increase in the money supply was in 2020, since 2022, so from 2022 to 2025, the money supply has only increased by 4.4%.
So there's been a constriction or a pullback.
That's right. That's the effect of quantitative tightening. And there came a time, when I first started, I hated macro. I was like, this doesn't matter. Like, why don't I just understand the fundamentals of this company? Why don't I just understand the fundamentals of how this property cash flows? And it's like, 30 years ago, 25 years ago, you could do that because the monetary policy was relatively consistent, but it's not anymore. It's like you might hear the term fiscal dominance, right? Fiscal dominance. It's like, what that means is, a lot of times the actions that the government and the central banks are taking are more significant than the otherwise industry specific fundamentals. And that's where we are, right? And that's the primary pullback from, when you get from 777 going all the way back down to the 691.
Right.
Because this pullback started long before Donald Trump. This pullback's been going on for 3 years, right?
Like they always have to have an enemy so that it takes the eyes off of what's really happening with the Canadian Central Bank and our government.
That's right. Goose the money supply beyond belief, beyond anything responsible for a year, and then constricted it beyond anything that was feasible for 3 years straight, right? And so we're seeing that compound, right? And I would say, like, largely, the increase in the money supply, that was a problem. That was a failure of the Bank of Canada. The restriction, once that was done, you're somewhat dependent on what the U.S. Federal Reserve does. Because if they constrict their money supply and you don't constrict your money supply, all of a sudden you got the Canadian snow peso at 50 cents on the dollar in the U.S. and you can't buy anything. You're kind of pulled along for the ride, but we probably wouldn't have had to do that if we didn't go right along with them to Crazy Town when that happened, right? And so, it's not what, Tiff Macklem has done post-COVID. That was the problem. It was what he did during COVID. Mm-hmm. Like post-COVID, you don't really have a choice. He had to constrict the money supply too because the U.S. was constricting the money supply. And if you don't, all of a sudden we won't be able to buy anything on the international market, and we don't manufacture a lot. So that's a problem, right?
If you listen really, really carefully, you can hear the money printer starting to fire up.
Oh yeah,
right?
Oh yeah. And so this is, what is being missed right now is, the real estate gurus they're getting it. I mean, they're probably looking a little too much at rates and purpose-built rentals. They're important, but they're not in the top four. Okay, maybe their honorable mentions 5 and 6. Okay, I think they are looking at jobs, they are looking at supply, they are looking at demand, but they're not looking at where the money supply is going. And we have to understand the money supply in the U.S., if you measure by the reverse repo market, which is the savings accounts of the commercial banks. They had $2.3 trillion there, and it's completely empty. Which in a crude description, that's the savings accounts of the U.S. commercial banks. Right?
So that means they're not lending as readily as they were. Is that right?
At that time, they were lending like a drunken sailor because they had so much money that they're trying to invest in it, and they had so much they're just parking at the Federal Reserve. That's since been completely drawn down. Okay, now you also have now they're into the actual repo facility, which is essentially their overdraft. Okay, now the U.S. banks, they're running on fumes. They're in their overdraft, right? And I think a lot of there's been a lot made about the U.S. general account that it's due to the government shutdowns, but which is true. The government shutdowns, there's less money coming out. There's still money coming in, yes, but they're also rolling over long duration treasuries into short duration treasuries, which my understanding of the plumbing of that is they actually need more cash on hand. So the cash that goes out post the shutdown might not be as much as everyone thinks. Okay. And the U.S. Federal Reserve has indicated they're done with quantitative tightening at the end of the month. They haven't said that they're doing quantitative easing, but I think the market interprets that, hey, the banks are out of money. They kind of ran out of money at the end of 2019. A lot of people don't know that because they increased the money supply, and then 3 months later they increased the money supply by a factor of 30. And so everyone forgot about that. But it was actually a problem in 2019. Now, what we don't know, in fairness, people are trying to project where this is going, is the U.S. government, had more quantitative tightening and for a longer period than it's ever done in history. So we know when you increase the money supply that it doesn't actually show up in prices sometimes for 24 months, right? Now, when you decrease and fire it back up again, how long does that take? We're all kind of guessing because they never did it for that long and that tight. So we don't know. Does that get rolling in is that 3 months or 3 years? We actually don't know the answer to that. But we know that the U.S. banking system is out of money, and we know the U.S. Federal Reserve recognizes it and has indicated that quantitative tightening is ended. And we know they don't really mean quantitative tightening is ended. They mean quantitative easing is starting. but how aggressive and how long it takes for that to reflect back into the market, which will effectively, give the Bank of Canada to do the same thing. They want to inject liquidity too, but they don't want 50 cents on the dollar on the exchange rate.
Yeah,
so,
for sure.
That's where we are. And so we have to understand. So those are the four variables that I see. And the honorable mention are rates and purpose-built rentals. Important. But Trevor, what do you think? Jobs, supply, and demand would trump that. Would you agree with me that if your population doubles, it would be more important than rates doubling?
That's just basic math.
That's just how it is.
Yeah, that's math. I completely agree that is how it is. And, I think really the biggest factor is the money supply. So the ability to get credit, the ability for banks to loan out money,
100%.
That's a huge deal,
Yes.
right?
Yes.
And that's going to affect really everything, right? Because it affects how much people can buy, what can be bought. And then when you look at the pricing of houses, the other three factors that you brought up, right? So population, jobs, those things. If people don't have jobs, we have more population, they can't borrow it anyways.
That's right.
Right?
Yeah.
So you got to come up with another solution. And I think maybe the new Senate bill that is coming out for suggesting a universal basic income for people 17 plus, boy, that would flood the market with a bunch of free money again. Right?
I mean, it's coming. It's just we don't know what year it's coming. We all know we all know this thing is like hanging over our heads, like it's coming, and there's really not much we can do about it, other than position ourselves with actually having the right assets. So, I mean, people look at this and assume that it will go down forever and the sky is falling. But I'm telling you, as bad as an economy can be, prices can go up because the money supply increases. Mm-hmm. And if you don't believe me, just go look at housing prices in Argentina. You know what I mean? Like now that's an exaggerated example, but it's important to understand those exaggerated examples because we're not expecting the economic factors to get as dire here, right? But even if they got half as dire, or a quarter as dire, like what happens is they fire up the money printer, and those houses in nominal terms start to go up, right? That's what the money printer does. It moves the wealth from the people who do the work to the people who own the assets. Now, houses are not the pristine asset. They're not going to keep pace with gold, unless you're in the most, unless you're in West Vancouver looking at the harbor, or you're in Bridle Path or something like that. Like you're not going to really get close to an ounce of gold. Okay, you're not going to get your 11%. Historically, Canadians are getting 5% on the appreciation, right? And a lot of communities might get less than that, right? But you do have to understand it's the increase in the money supply. If you're paying for with it Zimbabwe dollars at $20 billion notes, right? Guess what? It's going to go up, people. Yeah. That's just what it is. So, it's not just the risk of a deteriorating labor market that will decrease the price further. It's the risk of the money printer artificially increasing the asset.
Right. And that's the big takeaway that I think everybody who watches the show and has been paying attention is because of that right there. The asset prices will be going up because of the inflation or the devaluation of our currency.
Yes, right? you could see unemployment deteriorate further, and if they get reckless with budgets and the increase in the money supply, prices could still go up despite that, and it will shock everyone, right? And judging by the $78 billion budget that they felt perfectly comfortable passing, and no one was willing to vote it down. I heard two of them were like running out. I don't know if there's any truth to that, but apparently there was two conservatives who weren't going to vote against it, and they're going to pretend they're out of the room or something like that. But who knows, right? Either way, they got it passed.
Let's be real. Okay, they're politicians.
Yes,
they are not the ultimate type of person. They're not the A-type personality who would start a business and risk everything and go all out. These are the kind of people who are like, you know what? If we vote it down, then we're having to go to the polls during Christmas. I got plans.
Yeah, they all just want to destroy the currency at at different rates, but none of them have a chance. None of them have a plan to actually save it, right?
They have priorities, and we're not it.
Yeah. So those are the 4 factors. I just really want to put that out there so people understand, give them some perspective when they're evaluating, should I buy a house? Should I not buy a house? Don't panic sale. But first of all, I mean, you don't buy houses for where the price is going to be in a year or two. I mean, you got to buy houses with something you're going to hang on for 10 years. And I got to have the liquidity. And you see people where, they put 5% down on a house. That's risky. That's a risky point in your life. And people bought 2 or 3 of them. And, we try to show people at the boot camp how to use debt effectively. Okay. Because buying a couple of houses with 10% down when you got an ordinary job is incredibly risky, right? And then we start showing them, it's like, hey, you can, take 25% loan to value on a stock. And that's actually, much safer than buying one house at 95% loan to value. Look how many people are straight to zero, not even zero. When they sell it off, they actually wouldn't be able to pay off that mortgage at this point. They're underwater, right? You bought $1 million house with 10% down and it dropped by 20%. Like, you're negative equity.
Yeah,
you have negative equity at this point, right? And so learning how to manage those risks effectively, because the risk is both a deteriorating economic situation in terms of jobs, but it's also a deteriorating situation in terms of the value of the currency. And that's what we're facing here right now.
Big troubles. Well, that was very eye-opening. I hope that everybody understands what Josh is saying here. It's not just about the rates, and it's not just about the population. It is about more than just that. And the main thing is the money. The money is broken, folks. The money is broken.
Yes. And
you got to get a path to taking the fake money and getting into the real money.
Yes.
You got to do that.
Yes.
So any parting words, Josh?
I hope that's helpful. If someone wants to understand this more, we just had a really successful boot camp. We have our next boot camp coming up in May. A third of it's already sold out. A third of the tickets are already sold. They will not be available a month before. We show people how do you borrow the fake money responsibly to buy the real assets.
Yes.
Not just listen to real estate gurus on TikTok. We show you to just keep levering it up, and we'll give you a free car.
Yeah.
So
keyword responsible.
Yes.
Yeah. All right. Awesome. Thanks, Josh. Appreciate it. And we'll see you guys on the next one. See ya.